Good morning, everyone, and welcome to today's Zing 365 free webinar on the title of The Insurance Market Cycle, A Broker's View. I'm John Nutter, I'm your host today, and I'm joined by two great speakers. I'm joined by Helen Davies, who is our technical delivery specialist, and I'm also joined by Ian Stutz, who is the non-exec director at Clear Group. The main thing is that Ian is an absolutely distinguished guest, has had a good long career in the insurance industry, and is also in a great position to talk to us about his experience in the market cycles that have happened. In terms of today's session, we're aiming to run for around 45 minutes. 30 minutes of that should be a bit of discussion, and then 15 minutes for Q&A at the end. So as we go through, please use the chat function to put any questions to the speakers, and we'll get to those in the Q&A section. The last thing for me to say really is, and that's before I hand over to Helen, is really to say that today's session will be recorded and will be made available on our website, on our YouTube channel, and will also be sent out via email to you after the event. So without further ado, I'm going to close my mouth and I'm going to hand you over to Helen. Over to you, Helen.
Thanks, John. Thanks very much. So hopefully between the three of us, we will be in a position today to provide you with a better understanding of the market cycles, where the market stands currently, and what you can do as brokers to navigate through to achieve the best outcomes for you and your customers. There may be some brokers joining us today that haven't actually experienced the changes in the cycle. So therefore, I'm going to take it all the way back and just talk about how a cycle works. What are the kind of factors, the internal and external factors that influence it, and also shifting between that hard and soft market. Okay, so as you can see, the market isn't stagnant. It moves in response to internal and external factors, and it operates what we know are soft and hard markets. And the important thing to note is that no two cycles are the same. You can try and prepare for the softening or the hardening of market. However, there will be some differences. And also within that, each line of business might react differently depending if it's a soft or hard market as well. So what are the kind of indicators of a soft market? Premiums tend to be lower, insurers' capacity widens, and they are willing to take on more risk, which they would have previously declined before. New entrants into the market as well, but also be careful with that. Lower premiums don't always mean better. Sometimes when it comes to the claims, that's when you realise whether you've got a good product or not. When we come to a hard market, it's simply the reverse. Higher premiums, insurers withdrawing from the market and offering stricter terms. So if we look around the cycle here, we looked at increased healthy competition, what we call a buyer's market. Rates and premiums and terms are much more wider. But unfortunately, then once the claims start coming through, higher peaked claims, catastrophe claims, for example, or poor investment return, that's when insurers start to get a bit twitchy, tighten their purse strings, and then start offering those tighter terms or withdrawing completely from the market. So let's have a look at some of those internal and external factors. Okay, so economic and investment. So high interest rates will have an effect on investment income. When insurers have strong investment return, they can use this to accept lower underwriting margins. And then obviously when the reverse happens, insurers respond by tightening those terms and pricing. When inflation drops, claims costs tend to be lower, as materials and replacement parts will also then be lower. Another thing to factor in is social inflation. It's really important actually to consider that because this arises from people's attitudes. The UK tends to be shifting towards more of a US with their claiming habits and behaviour. Claims and catastrophe events then. So large CAT events mean large losses for insurers as well as reinsurers. And that can move to change in pricing and risk appetite. And just to give you a kind of an example of that, really, if you think about the period of 24-25, we had a series of storms. We had Henk, Kathleen, Bert, Connell and Dara. Flood claims were up roughly about 40%, and the average payout was £30,000. With repeated flooding, insurers were also looking at frequency in addition to severity. Market capacity. When the industry is making a profit, increased capital is readily available and new businesses enter into the market. This leads to that healthy increased competition, which forces insurers to decrease their premiums. When it comes to regulatory changes, I'm just going to give you a few just to have a kind of a better understanding, a clearer understanding. Post-Brexit reforms, Solvency II, introduced in around 2016, increased capital requirements for long-tail claims and cat risks. This contributed to the 2019-2022 hard market. Ogden rate changes in 2017, minus 0.75%, meaning higher PI claims, higher reserves had to be set aside for those types of claims. So, of course, motor insurers are affected. Slightly changing from that, then more recently, we've had those whiplash reforms, and also in January of last year, the rates obviously changed, aligned with Scotland, plus 0.5%. So that's brought about changes in the motor market. Lastly, 24 to 26, early softening due to Solvency UK reforms. Insurers don't have to set aside as much capital, which will encourage underwriters to write more business competitively. This will also allow them to have more flexibility with their investments as well. So next up, I'm going to take you through a kind of a market cycle timeline to kind of point out some key areas of a hard and soft market as well. And interestingly, as you'll see, there's usually a massive event that kind of triggers that hard market. So if we look at 2001 to 2004, obviously we had 9/11 round about that period. So Lloyd's of London obviously insured, largest single loss of that time, massive price increases, and obviously investment income depleted, leading into that hard market. The period of 2008 to 2018, a long period of a softening market there. Low interest rates equals reduced investment income for insurers, encouraged premium growth, writing more business at that time as well. Lloyd's of London and the London market, new syndicates and managing agents coming in, capacity increasing for existing, and international capital flowed into the market. Reinsurance competitively priced at that time, which reflects in insurers' premiums, because obviously when the opposite happens, insurers tend to pass those increases on. 2019 to 2022, another hard market shift. COVID-19 brought about high inflation. I think we all were kind of affected and know about what happened with COVID-19, labour shortages and high construction costs, to name a few. More recently, 2024 to 26, and I have got a little star here because it's a softening of the market. And again, it's not all lines that are affected, but insurers' profits are healthy, increased capacity and competition that we've mentioned already. So we're going to have a look at some lines, because are all lines affected in the same way? No, they're not, as I mentioned earlier. And they can experience different periods in a hard and soft market. So we think about property, for example. The start of last year saw increases in claims, largely due to cost of materials and labour. Toward the end of last year, moving into early 2026, softening market continues in some areas only, but we're still seeing some struggles with flood exposed risks and construction, for example. Insurers are offering slightly wider terms, and those restrictive terms that were there before are being withdrawn, such as higher excesses. Professional indemnity, the market continues to soften towards the end of last year, driven by stronger competition. There's new insurers coming into the market. Greater capacity coming from both those existing and new insurers as well, particularly well placed for well-managed risks and good claim history as well. Some insurers are also expanding and enhancing their cover as well, which is really good, healthy competition as well. This is just an overview because there are still some professions that are suffering under professional indemnity, such as construction. When it comes to cyber, it's a buyer-friendly market. However, this may start to change throughout this year. As new risks emerge, insurers are starting to become a bit cautious, favouring risks that can evidence a good claims history together with a strong risk management policy. And then lastly, motor. Not boding as so well as the others. Factors really are increased claims. Last year, there was a lot of healthy reduced premiums. So increased claims, supply chain issues, and increased repair costs all playing their part. Competitive pricing affecting profits. Some stabilization with fleet, however, discounts are being offered for the use of things such as telematics. Okay, so that's just a kind of an overview there of the market, and some of the factors do affect that as well. I'm going to hand you back now to John to have a broker's view with Ian. Thanks, John.
Excellent. Thank you, Helen. And you've made me feel particularly old, bearing in mind I have sat in this industry throughout all of those examples that you mentioned. But yeah, thank you. So at this stage, what I wanted to do, we've got that clear technical view on what a market cycle is. I wanted to kind of come over to Ian now, if that's all right. And Ian, first of all, as your role as non-exec director of Clear, it'd be really good to know what's being talked about with the market the way it is at the moment, and what are you seeing? But also, I'm really keen to understand kind of your experience throughout the years of how the market cycles have gone, really. So,
okay, John. Yeah, good morning, everybody. Thank you for the introduction. And yes, my experience of the market cycle goes back into the 80s, and it's true that, and very well explained by Helen, the way of which the market works. But what's interesting is that no soft or hard market is ever exactly the same, and maybe we'll get into some of the sort of differences. But to your question, what are we talking about at the moment? Well, the general feeling is that this soft market still has some time to run. So we could see a fairly lengthy period going into 2027 where the rates are possibly even going down for the balance of this year, but remaining soft for next year. So we have to work within that environment, and that presents some very obvious challenges.
Right. In terms of, obviously, we talked about some really significant things that have happened in the world that have affected the market cycles previously. We've got a war on at the moment. We've got a couple of wars. We've got a lot happening with the economy and in politics. Do we not think that actually we're going to get some change because of that at this stage?
I mean, I was once told very many years ago when I was at college that if you laid all the economists out end to end, they'd never reach a conclusion. I think is how the saying goes. And so the answer is, what market you're in, but it's very hard to know when you're coming out of it. And I think Helen very well described the fact that sometimes it's events that you can't see. I don't think anything that's happening at the moment is going to change it quickly. I mean, it may cause a gradual change, but there's nothing to suggest it's going to change quickly. And so we have to prepare ourselves for this is the market we're in. But I think it's quite, there's a few things as brokers that we have to watch for. My experience is that the turning market, so going from hard to soft or from soft to hard, is the most challenging one we face, because it's a great opportunity for competing brokers to undermine your ability to predict what your client's premium is going to be at their next renewal. So I think that in itself is a real challenge. So whilst we're still in a softening phase, and the feedback we get from the market at the moment that in some areas rates are still falling, that's a real challenge when you're trying to hold on to your clients, to come across as having good advice. And I think what's really important when you're talking to your clients and talking to them early and taking the detail that Helen's provided, as a broker, you need to be able to explain why rates are where they are. I think that's that helps you through the process. The other fact is that we've had markets in the past, maybe not since 2004, which was the period we talked about, where we live in an incredibly benign economy. We've had soft markets in the past that have actually dovetailed with a booming economy. And so you have the opportunity to quite easily cross-sell and upsell. The client has money to spend, their insurance bill is going down, and it is not difficult then to sell extra lines of business and create a greater risk. The trouble with this particular soft market is a lot of clients in certain sectors are really suffering. And so we have a position where we've got, as a broker, we're getting little or no organic growth on our existing clients. And in some instances, we've got clients who, even though the premiums are down, are finding them hard to pay for. So that in itself presents further challenges when you're sat in front of a client.
So you talked about the challenges in front of those clients. I guess I know this is a hard question probably to ask, but what is your advice then to deal with that? If the clients right now are suffering with a market where they don't have a lot of cash, rates are coming down, so you're potentially delivering good news. What's your advice if you're a broker at this stage?
Okay, I mean, you can never beat having a great relationship with your client, and a great relationship with your client is being able to go in, having conversations, and make some assessments or predictions about where their premium may be. Even that might be hard if, when you get to the renewal, the premiums still come down. But if you've got a great relationship and a competing broker is trying to get in there, if the relationship is good and the trust is there, they should at least give you another chance to go back to your market to get the right price. That's just a competitive issue. The other challenges are that you have to sort of play the long game, and it might well be that your earnings are going to be down on your account, and then you've got to make sure that you are managing a policy count, that you come out of this market cycle with a policy count that looks pretty similar to the one you went into it, even if you're not earning quite as much money. The other factor is there is a danger if you're not comfortable with your relationship with the client, or the client appears to be putting you under pressure to say, can you do better on the price, that you put all the risk to market. And the enemy for us as a broker is having too many risks in the market. We just don't have the resource levels to be able to market everything. And so there's policy count is something to look for. And the second thing to look for is minimizing your marketing, reaching an agreement with a client early on a premium where they sign off, and then you can get it agreed with the holding market and move forward. Those are the sorts of things that you've got to do.
Excellent. Just a reminder to everybody who's on the call today listening, please do use the chat function to put any questions to us. We'll be heading into the Q&A section very shortly, actually. Ian, just, my previous role was with an insurer. What are you seeing from the insurers right now? Is there anything in particular, or is there any one that stands out that are doing things differently, or are they all pretty much doing the same stuff?
No, I think Helen made a very good point that there will be insurers who provide a full and rounded service. And it's really important, again, if you have a great relationship with your client, that you may well present that there are potentially some new entrants or insurers who will be quoting for the risk today that haven't quoted in the past. But there's a price to pay for having an insurer that's been around for a long time, and when there's a problem, they do pay the claim. So everybody on this call who markets risk will know that there is a difference between the quality insurers and those that are looking to maybe fill their capacity quickly, and that needs to be explained to the client. You've obviously got to show alternatives when you're going into the client to show that you know what's going on in the market. But again, it's really important that you're able to communicate clearly the differences between a good, strong market that's going to be around for a period of time versus some of the here today, gone tomorrow players.
Okay. I know from talking to brokers while I've been out training that A lot of the sales guys are struggling at the moment with those conversations, and they are marketing regularly, but that seems to be forced by the client. Um, and I think they're feeling the pressure. So it feels odd to me that prices are coming down, but actually, there are further pressures on the brokers out there. What advice? I know we've given a couple of bits already, but if you were going to say one thing to those brokers that are feeling the stress and the pressure and of trying to keep hold of those clients, what advice would you give them, Ian?
Well, I'm afraid the advice is you have to build and maintain strong relationships with clients. It's obvious stuff, but it's really important. Ultimately, if you have a trusting relationship with your client, you should have the confidence to be able to go in early and have good quality conversations about what's going to happen to their premiums and get a level of sign off. Equally, you may get a level of sign off and somebody unbeknown to you has gone in, maybe provided a rogue quote, and the client feels undermined. If the relationship's strong, they should come back to you and ask your view on that, and you'll get another opportunity. The other part is you need to also maintain very strong relationships with your carrier partners, and it's probably important that depending on how much premium flows through your books, that you do have one, two, three, four, or five. It depends how big your brokerage is, but you do have a number of good quality relationships so that you can at least have some meaningful discussions with those insurers to get something that is competitive in the market when you're looking to renew a case.
Excellent. Okay. Well, I'll start moving over to some of the questions that have come in now. So we have got a question. How can brokers use a softening market to improve policy terms and limits and insurer relationships rather than focusing on the rate reduction? So it's quite a big question there. Thank you very much.
No, that's a great question. And again, if you know your client, you will know what their financial circumstances are, and inevitably, albeit I've said that it's a benign economy and some areas of the economy are struggling, particularly in the independent broker books and maybe the smaller end of commercial within some of the larger brokers, you still have entrepreneurial businesses who, however hard it is, are managing to grow. And if you've got one of those clients and you recognize that their balance sheet is strong, then it's a good opportunity to say, look, rather than take a reduction in your premium, why don't you have belt and braces cover? Look for additional covers or maybe increasing indemnity limits and the like. But the first part of that conundrum is to understand how strong the balance sheet of your client is. Because equally, there are some clients out there who are struggling, and you may even have to go the other way and provide a more limited cover or whatever they can afford.
Okay. Thank you for all these questions that are coming in now. There's a follow-up actually saying even some long-standing clients seem to be prioritizing premium savings over cover and service levels. Any thoughts on how we deal with that?
Yeah, I mean, when I've been handling or been an account executive, and again, you've got to trust the client-facing individual in this. The first priority as a broker is to renew your case. So you have to understand the issues they're under. So if a client comes to you and says they want to forego quality coverage, or maybe they want higher deductibles, or maybe they want a lower indemnity limit, or whatever it might be, you've just got to scratch the surface to find out exactly why. If it's a genuine financial issue, it's the difference between if they paying premium or maybe losing one or two members of staff, they're probably going to reduce their premium. If they're in that desperate state, then obviously you've got to support them in it. But you need to probe and push to see exactly why they're doing it. Because if you've got a client who doesn't understand not having a good quality insurer or not having client claims paid and just thinks it's one insurer is the same as the other, so why don't I just try and save some money, they could have some problems down the line. But all of that, you can't solve and create your relationship now. Hopefully that's all the hard work you've been doing over the last few years, so you can ask those difficult questions.
Excellent. Okay. Next question. It's a really good one, actually. We obviously we went through a period of a mass of M&A activity, lots of brokers being swallowed up. What are you seeing at the moment, Ian, in terms of M&A and is there a move to specialist firms, or is there a competitive advantage that top leading big broker firms have out there, or is that decreasing, do you think?
Yeah, I'm not sure the context in that, in terms of the soft or hard market, and maybe the question is coming from a perspective of competition. My view is the market has really been hollowed out by consolidation. So there's always inevitably going to be some larger brokers that won't sell for whatever reason, and outside of those, most of the businesses, either through an age profile or for whatever reason, they have sold. For the consolidators, there's a size issue. They're looking to buy businesses of a certain size, and there aren't many left. So realistically, consolidation is slowing down. Now, what that does in terms of the soft and hard market, I'm not entirely sure, but I don't see there being large scale further consolidation of the traditional independent market as we know.
Excellent. Okay. Just to confirm, it was from a competition point of view. So do you want to put on a further point there? So, okay, thank you for that. What's the biggest thing Ian has learned from his experience of previous market cycles? That's a big question, Ian.
Yeah, I mean, we all learn, as I say, you learn from the cycles, but one thing you do learn is they're never exactly the same. But I mean, look, the biggest thing I've ever learned is that if you have a great relationship with the client, and if you have a great relationship, and you can only have a great relationship with a limited number of insurers because you can only place so much premium in the market. If you have a great relationship with your client and key insurers, you are going to have the best outcome in a turning market. In terms of what are my learnings from a soft market, and this is difficult, particularly for the private equity backed models, but sometimes when you're in a market like you are now, winning business is difficult, organic growth is difficult, and it's about holding on to what you've got and accepting that maybe the profits may be slightly flat for a year or two, and it's a question of battening down the hatches. Now, it was easy for me when we owned our own business. We could batten down the hatches, and I know that's not quite so easy for some of the larger businesses that have bills to pay and interest on loans, etc., etc. But yeah, sometimes you just have to accept the market where it's at. The one thing you can't do, this is in my opinion that I've learned through the market cycles, you can't throw money at trying to win more business, because the cost of winning is expensive. So let's say, and I don't know, I'm making this number up, let's say today it costs £3 or £4 to win £1 of income. And in this current market, that cost goes up to £10 to win £1 of income. Logic says you'd be better off spending that money on trying to hold on to what you've got. And that's probably the main thing I learned, certainly when we were running the business, to try and see yourself through these difficult markets.
Okay. One more question. I guess we've talked about the positives, and I think we've got a slide coming up actually that talks about the key things that you need to think about in the market cycle as it is at the moment. But from a mistakes point of view, Ian, in your experience, have you made mistakes along the way? What do you see are the big mistakes that brokers make, and hopefully we can get people to avoid doing that this time round.
We haven't got time to go through how many mistakes I've made, John. Yeah. Mistakes I've made. I think I mean, the easiest way is to say it when I didn't have the experience that I now have. So the easiest mistakes to make are not talking to your client early, because you think if you go in right at the end with your terms, that's likely to secure the business. I have learned you're always better to create a good relationship with your client and be honest and upfront and talk to them early. And the second one is, and it's to be quite pushy on it, because a number of insurers, to this day, think that providing terms late, I know you're constrained by some of the regulation around providing terms on time, but some insurers still think by providing their best terms late, that is a way of securing renewal. And again, my experience was to have good enough relationships with insurers to, even if it wasn't down absolutely in writing, to get a fair indication of where the premium was likely to be when we got to renewal, subject to there not being any claims in the intervening period.
Excellent. And thank you for admitting that mistakes are made there, Ian.
Well, that's not such a big admission, John, actually, because my experience is you learn far more by making mistakes than sort of ploughing through life thinking you've got everything right. And you have to, and for everybody, nobody's going to have one renewal. I would say try something different on a renewal if you're having a difficult experience, and try a different way to try and create the trust between you and your client. As I say, whichever market cycle you're in, whether it's turning, whether it's soft or hard, you never can beat having a fantastic relationship with your client.
Excellent. I know, Helen, you've brought the tips up there, and I'll give you a chance to go through those in a second if that's all right. But we've just got one more question. This is very clearly coming in from someone who's got a massive sales focus, I can tell. So when an experienced account exec is faced with a long-term client facing a price objection, a great relationship is important. But what are some great questions that an account exec can ask the client to help them see past price alone and the implication for them only looking at the price alone? Over to you, Ian. Sorry, it's a long question.
Well, I think you have to be able to impress on your client the importance of an insurer being there when you have a problem. That's the whole basis of having insurance, and therefore you have to be able to, through questioning, create an understanding of why you need good quality cover, why you need somebody who's going to pay claims. And sometimes that's difficult if a client hasn't had a claim of any size, but you have to be able to recreate that experience so that they know what they would face in times of difficulties. I mean, any questions that can create a trust that, my view whenever I went in to see a client was the client was an expert in whatever they did, manufacturing, build, whatever they were the expert in that. But I always went into a client meeting believing I was the expert in insurance. And therefore you want to have a series of questions to your client that shows an understanding of their business, but a series of questions that you can demonstrate that they are effectively ceding control of looking after their insurance needs to you. And where account executives sometimes come unstuck is they pay too much deference to the client, and the client then starts to believe insurance is easy and they know more than the broker. And that's a dangerous place to be.
I think a good thing as well is having those questions to the AE, and from the AE is putting the customer in the situation. What would you do if this happened, or how would you react? Do you have the financial backing or internal funding to deal with this type of scenario? So kind of giving them different scenarios as well, and how would you react? What would you do? based on their responses, then obviously linking it up with certain products that they can obviously would work in that situation as well.
Yeah, I think certainly in my experience, if you're dealing with a client who is running their business on a day-to-day basis, that business is like their baby. It's something that they live and breathe and would almost die for. So they generally see the importance of it, but it's about bringing that to life a little bit and helping them to see what could happen without scaring them completely, but what could happen if the worst does happen. And where the value is in insurance and not just going for the cheaper price. Absolutely. Well, thank you very much to everybody who sent in some questions there. We've still got a few minutes left, so if there are any more questions, please fire them into the chat window and we'll try and get them answered. Helen, I just wanted to give you a chance to go through the slide that we brought up now around the kind of 5 key tips. And Ian, if you want to interject on any of these, please do. So, Helen.
Yeah, there is another question, John, as well. I don't know whether you've seen that in the Q&A, but do you want me to do the tips first of all, and then go back to that question?
Yes, go on then.
Yeah, okay, perfect. To be honest, some of these have already been discussed by Ian, but just some kind of 5 quick tips to try and help navigate through that kind of period of soft, hard market, really. So with that, continuing to build that strong relationship with both your customer and insurers, which Ian's already said, building that rapport, as we know, leads to trust. Having those open discussions with your clients, educate them as to why the shifts are happening. In addition to building trust with the customers, also think about your insurers. As Ian's already said, stick with them through hard and soft market, because if you keep leapfrogging between different insurers, you're going to come unstuck as a broker. Reach out to insurers early as well. What can and can't they do? The earlier you know this, the better equipped you will be to have those discussions with your clients and basically setting those expectations. Make sure you have accurate, up-to-date risk information to present to insurers as well. Worst thing is going back and forth, wasting time, gathering additional information. So try and get that done at the very start, the get-go. What are your clients doing in terms of risk management as well? What are their contingency plans? As we've said already, insurers tend to look favourable on that if they've got a robust risk management plan in place, especially if they've had a claim. What steps have they done since the claim to try and mitigate that, any future events from happening? So that's kind of the top tips we've kind of discussed and went through. And then lastly, really, when it is in a softening market, try and get better cover for your customer, whereas before it's restricted, maybe lower excesses or wider terms. Thanks, John.
So no worries. Ian, we've got a couple more questions coming, but any thoughts on those tips?
Yeah, just on that last one about increasing cover. One of the great things, if you do manage to increase cover in a soft market, it very rarely gets cancelled when the rates harden.
Oh, okay.
Yeah, good point.
And there is, under insurance is still a massive issue out there. So it is potentially a good opportunity to address that. Okay, so we've got a question that's coming from James, but whether this is to Ian or to both of you. It says, can we have a further explanation of how to understand a client's balance sheet? Ian, in your experience, what have you done, from that point of view to get to grips with a client's balance sheet?
Right, it depends on the complexity of the client, but if we're talking about a large client, then I would suggest, and certainly something I had in the early days when I started out as an account executive, is whether it's through your own work or maybe even through Zing, I would get some basic training on understanding how accounts work. I would take the accounts of that business and don't try and wing it. Understand some key questions about their cash flow, or maybe you can see something about how strong they are in certain areas. There's plenty you can pick up from the public accounts of your client. But you probably, if you've not done it before, I would suggest you get some training, because you certainly don't want to go in not understanding a balance sheet.
Yeah, absolutely. And having delivered many a management program where we've included advice from accountants, it is important. You get it generally. Certainly, in my view, you look at an account, a set of accounts. There are things that stand out, but if you can have that expert view, if you can have somebody that can really kind of point out the small things that probably will make a big difference, that's certainly something I would advise.
All you're trying to do, John, is get a couple of areas that one. I mean, if nothing else, it shows the client that you care, that you've done some research, that you've actually looked at them as a business rather than just take a lengthy tome of a renewal report to them and read it out. So it's showing an interest in them, and all you're really trying to do is there a couple of little areas that you could say, I noticed from your balance sheet X, I was just interested to know whether that means Y. And you start a conversation, and the client thinks, great, you care about me, you've looked into it, and and it might be nothing at the end of the day, but at least you've shown an understanding.
Yeah, certainly things like, big chunks of income coming in, big costs, things like that might explain the need for a particular machine or whatever, things that need insuring. So yeah, that kind of high level view on a set of accounts can really make a difference. Absolutely. Right, we've probably got time for one more question, if that's all right. So this one says does the panel have any views on where underwriters draw the line between competition but avoiding underpricing that can then create problems later? Ooh, that's a difficult one. So, obviously we can see the underwriters are allowing prices to come down, but where will they put their foot on the line? I guess. Ian, any thoughts on that one?
Well, I always think of one insurer. I had a fantastic relationship with one insurer, and I mean, we're all trained in negotiation, and we've probably all done those sort of breakout sessions where we do mock negotiations, and the fact is, every insurer will have their price, and it'll be written on a piece of paper, and you can't see that piece of paper, and they're obviously going to want to go strike a deal before they reach the price written on that piece of paper. And really, the only way that you ever find what that, and they're not going to go below the level that they have authorization to. You just can't. I mean, there will be rules and guidelines in place for every insurer in that regard. But you've got the skill of your negotiation is to get that number written on a piece of paper. And I'm afraid I come back to the same old thing. It's using an insurer frequently, you get to understand their negotiating style, you get to understand what their degree of tolerance is, and you're likely to find the bottom price. If you are merely sending out a presentation to an insurer that you've never engaged with or engaged with very rarely, how can you possibly tell what their negotiating stance is and whether you're at the right price or not? And so it's about, yes, you've got to always test the market. You will hear about entrants coming in, and you've got to go and talk to them, because if you don't, a competitor will. So you've got to talk to them, but it's about having 3, 4, 5 really good relationships where the relationship is good enough that you either understand their negotiating stance and you know how hard you can push them, or it's so good that you're actually really honest and upfront and say, look, this is the best. The underwriter says this is the best price, and you absolutely believe it is.
What do we always say? The insurance industry is absolutely a relationship industry, whether it's a relationship with your client, a relationship with your insurers, or a relationship with your peers. At the end of the day, you've got to be good at relationships to be good in insurance. Would you agree?
I totally agree with that, John, but I also think businesses operate in a particular way. And once you understand how they operate, then it's easier to negotiate. And the only way you'll understand how they operate is to use them frequently. And whether it's, it'll be different underwriters doing different lines, but they're still coming across because they're all trained in the same way in providing the same response. So yes, it's no doubt the better the relationship, the easier it is to get there, because relationships means being open with each other. But if it's not there, the other fallback is I use them all the time. I know exactly what they're going to do in this particular circumstance.
I think as well, I agree, Ian, there. If you've got that good relationship with them, you know how far you can push them as well, to get that risk over the line as well, I think.
Excellent. Well, we have hit our 45-minute mark. So what I wanted to say is a massive thank you to our speakers, to Helen and to Ian, for your time today. And more so, a massive thank you to our audience for joining us. It's great to see so many people with us on this call, and there will be future webinars, so please do keep an eye out for those. As I mentioned earlier in the session, we have recorded today's session. It will be made available on the YouTube channel, on the website, and hopefully it will be emailed out to you as well. Other than that, it's just left for me to say thank you very much. Good to see you all. Enjoy the sunshine, and we'll see you again soon. Thanks a lot.